Hey everyone, Ahsan Raza here from Century 21 Innovative Realty, and welcome to our newest webinar episode. Today I've got a great guest today on the show, and we're going to talk about something that a lot of you guys have asked me for several times, and that's the topic of real estate accounting and tax strategies. So in this episode, we're going to cover things like capital gains taxes. What can you claim when you have a rental property? What are should you incorporate or should you buy it in your personal name? What are some HST rebates that are out there? So this and everything else, I'm gonna have my guest cover, and we hope you enjoy it. We hope that it makes you make an informed decision in the future. And yeah, all the best, and let's get through it. So thank you so much. I've got Mr. Ali Raza Jaffer on the show. Welcome.
Thank you.
Yeah, I know we've been trying to meet for a while now. We finally made this happen, so thank you for your time. Before we get into the nitty-gritty of things, why don't you give us a quick introduction as to how you got started and when you got into your own firm. I see that you're here part of AR Jaffer Professional Corporation. So just give us a background as to how you started.
Absolutely. First of all, thank you for having me here. So I've been in practice, public practice, for about 17 years. Prior to that, I did various accounting roles, director, controllership roles in large corporations. And I decided that, you know what, I just wasn't satisfied with what I was doing, and I wanted to kind of take it to the next level. And help out a lot of the different, whether it be a business owner or individual, to take their personal net worth to the next level. And that's really helped me out in terms of guiding them, looking at different tax strategies, looking at different business strategies to help people grow their business and grow their overall well-being, to help them prepare for retirement, which is the ultimate goal.
Now I know you're a family man, I'm a family man as well, so how do you balance all this stuff?
It is challenging, but it can be done. First of all, I've got a great team that works with me. Nice. Number one. Number two is my spouse. She's great because she handles a lot of the items at home. We balance a lot of the extracurricular activities. Nice. A lot of our kids are in competitive sports, so that really helps out. But overall, everybody has a role, and including myself in working with my clients to get them to that next level.
Awesome. That's good, man. That's good to hear. So it is going to get a little bit technical, but Ali Raza is the perfect guy to break it down in detail. So let's start with the easy stuff right now. All right. I think the most common question I get from a lot of my clients, I'm sure you get it as well, is what are some things that an investor can claim when they have a rental property? So some of the misconceptions that I hear a lot is that I can claim the entire mortgage amount, but I know you have more to talk about that. What are some things that we can claim as investors, and how does that impact our tax strategy?
You bring up a good point. In the misconception out there is that when you have a mortgage of, say, $2,000 per month on a property, you can claim that full amount. What I recommend is at the end of the year, the investors should prepare a copy of their bank statement or the actual mortgage statement, and that breaks out how much principal you've paid and how much interest you paid. The interest portion is deductible. On top of that, if you've got a condo investment, you can claim the condo fees. Okay. Any repairs that you've done. Now we have to be careful on the repairs. If it's a small minor repair, no problem, we can write that off. If it is something that's going to last for a significant period of time, then we would be able to capitalize that over a period of time. Okay. Other items are of note are insurance expenses, property taxes, and sometimes if you've got a condo or a house that is far away, like I know a lot of people are going to outside of Ontario or even within Ontario, you can claim auto expenses if you're frequently visiting the property. Yeah. So those are kind of the main items. Certain cases there are utilities that you can claim if you are paying for whether it be the internet or sometimes the utilities in the condo, then those are all fair game from a deductibility point of view.
What about, let's say, like a property management expense? Is that something that you can claim as well?
Absolutely. Yeah. So let's say, for example, you hire a property manager to take care of the property. That's one thing. Or sometimes what happens is real estate agents, what they do is they charge first month's rent, right? And those are all deductible.
Okay, that's good to know. So that talks about basically what you can claim as a rental property. If you have questions, of course, you can reach out to Ali later on. But just talk about the next question that I have here is capital gains. That's something that a lot of people throw out, and one thing that I see a lot is a lot of my buyers, like before they buy or sell a property, I don't think they always take into consideration tax implications, right? And so that's where I always say, okay, speak to a realtor, speak to a mortgage broker, speak to a lawyer, but also speak to an accountant like yourself. Because now you know the numbers before going in. And like I said, you want to make an informed decision, right? So capital gains sometimes, although we hear a lot, not a lot of people realize that there is a capital gains implication.
Yes.
So can you talk a little bit about what it is exactly and how does it impact someone when they are selling a property? And also just touch up on how can you reduce those taxes as well, if there is a way.
So capital gains, for example, let's just start from the basics on the definition of a capital gain. A capital gain is the difference between what you are selling the property for versus what you bought the property. Normally, obviously, if the value goes up, you have a capital gain. If the value goes down, you have a capital loss. Yeah. Now, what we can add on to the cost of the property are certain deductions, such as your real estate fees, legal fees, lawyer fees. Those are all fair game. Sometimes you'll do kind of a reno to make the property look good,
right,
and available for sale. Staging expenses are very common.
Yeah.
So those are, and this is all about investment properties. Obviously, when you have a principal residence, you have the principal residence exemption.
Right.
And those are exempt from any capital gains that you have to pay. I think those are the main things we need to take into account. Now, when we approach these matters, what we should do is we should look at the long-term picture. Yeah. Is the property going to result in overall cash flow positive, a cash flow positive situation for you and your family? Because there's a capital gains component, which is a tax on the capital gain, which I'll talk about in a moment. And then there's the cash that you're actually receiving. Right. Those are actually two distinct elements. The actual capital gains, if you're an individual, then it depends on your marginal tax rate. Marginal tax rates can start from 15% and go all the way to about 53% in Ontario. When you're a property manager or you're a corporation, then it can range. Generally, it is about 50% of whatever you earn is the tax rate that you're going to be paying. Now, keep in mind that there's an inclusion rate that only 50% of whatever you earn on the property. So let's use a simple example. You buy a property for $100. Yeah. You sell it for $200. Yeah. Your profit is $100, which is a capital gain.
Right.
Yeah. Now, in that capital gain, only 50% of that, namely $50,000, is taxable.
Yeah.
Okay. So that's a very distinct point because sometimes people feel that you're going to be paying tax on the full 100,000. Right.
Yeah. Okay. So just to kind of repeat what you said, so if you bought a property for $100,000, you sell it for $200,000. That's $100,000 profit. You're not paying tax on the $100,000. You're paying tax on 50% of that.
Yes.
And in that 50%, you can claim certain expenses. Correct?
Exactly.
Okay. Now, what if you have a spouse who's also on title? Can you sort of split that or to reduce the taxes? Is that something that you can use as a strategy as well?
Usually what I do is when the property is being purchased, I will ensure that we look at some tax planning strategies because the ultimate goal is you can't plan when you sell the property. You've got to plan from the start.
Correct. Yeah.
And what we do is we look at opportunities of minimizing your taxes. Right. Again, keeping everything all clean with CRA. Yeah. So we would, in some cases, put the spouse on title. Okay. And in some cases, we'd put other family members on title. Right. Keeping in mind that the property is registered with the city. Okay. Once the property is registered with the city, this is what gets reported to CRA. Yeah. So you have to make sure that that's very consistent, right, to avoid any reviews or audits from CRA.
Gotcha. Okay. You touched up on flipping and tax implications for that. So let's talk a little bit about that. It was very common in our industry before to buy, let's say, a condo and then flip it, as early as like 6 months, even within less than a year, right? But now what are you kind of seeing? What are the implications of, let's say, a quick sale or within under 12 months or whatever it is? What are some tax implications for someone who has that strategy of flipping a property, assignment? Just kind of delve into, what we can talk about.
Yes.
There.
So I would put that into two categories. One is flipping on assignment. Okay. Assignment is when you change the ownership of a property to another owner, right, before the actual condo or house closes. Yep. And then the second one would be an actual flip within 12 months, or even if it's a little after 12 months. Yeah. CRA, about 5-6 years ago, they implemented a plan whereby all of these are going to be 100% audited. Okay. And they have been. I haven't seen too many of them in terms of it happening right away, but usually 2 to 3 years later. Right. Obviously, with COVID being a bit of a delay, they're a little behind, but these are all going to be audited.
Okay.
So one advice I would give the viewers is just to ensure that whenever you are looking at flipping a property, to seek advice.
Okay.
Make sure that, again, as I said earlier, plan for the future.
Yeah.
Because you don't want any surprises, because you may have that money allotted for certain items, or be personal, vacation, renovations, to make sure that you've got your tax strategies in place early. Okay. And what ends up happening is if you end up flipping a property, you would actually have to pay the instead of it being reported as actual capital gains, it would be reported as business income.
Right. Okay.
The difference between the two is you no longer get that 50% inclusion rate that I had mentioned earlier.
Right.
So that has a significant impact.
Got it.
You can still deduct the same expenses, whether it be closing costs, land transfer tax, your legal fees, accounting fees, renovations, but you no longer get that 50% inclusion rate. On an assignment, it's very similar.
Yeah.
The only difference is that now you're subject to HST.
Okay.
So basically, whatever deposit you paid, whatever you sell the property for, including the deposit that you paid, that amount is subject to HST, and you have to then report, the 13%.
Got it.
On the sale amount.
Okay.
So it's very complicated, but at the end of the day, you should seek advice before doing so, because I've had situations where I was unaware of some of these situations, and I would inherit a client, and they would be in a situation where they have had to pay the HST, and they were assessed by CRA to make that HST payment.
Right. So the question I had was, you talked about this being considered as business income, right? And when we talked about capital gains, that was only 50% taxable.
Right.
So why is there a difference? Why isn't it that a regular investment property, which was being taxed as capital gains, how come that's not being considered as business income?
CRA goes on the notion of intent. So basically, if you bought a property and you're renting it out, that is an investment property.
Gotcha.
So basically, you've been renting it out for a few years. You've got a history of multiple properties, renting it out. But if you're in the business of flipping, meaning you end up buying one, sell it within 12 months, buy another one, sell it within 12 months, that is what's considered business income.
Right, okay.
In the earlier case, where you're physically renting it out and it is an investment property, it is considered a capital property.
Got it.
So CRA has really honed onto this over the last few years.
Yeah.
And because the housing market has been booming, I think it makes sense to kind of check with your lawyer, check with your real estate agent, check with your accountant to ensure that you've got your ducks in a row to make the right decision.
Would you say that was probably the main reason why they implemented this a few years ago, because of the booming in the housing market?
I think part of it was the booming in the housing market, and also it's not just the volume of sales; it's the growth in the actual price of homes in Ontario, which I think in Toronto are above $1 million now, right? Yeah. On average.
Right. So let's talk a little bit about some of the exceptions to that rule, right? So I know you mentioned there was a few exceptions to the proposed anti-flipping rules. So where would it be considered where somebody wouldn't be, considered in this bracket, and how would they take advantage of those exceptions? Right.
So let's say, for example, you buy, I know condos take usually 4 or 5 years, 6 years to build. And your intent is, I want to buy this, and I might be single at the time, or I might be married, but without any kids. Your life situation changes when the condo is ready to close.
Yeah.
So if you end up selling that home, your intent is different. Right. So it may not be considered part of the flipping rules. Okay. Again, you have to provide all of the details and all of your personal history to justify your claim of why you're selling the home without having it taxed at a higher rate.
Right.
Okay. Or maybe it was your principal residence, and it wasn't considered part of a flipping rule.
Yes.
And let's say your life situation changes, whereby you have a health issue in the family, you have a death in the family, somebody's got a disability, that would change CRA's assessment of it being considered business income, or flipping, or even yet a capital gain. Again, every situation is different.
Yeah.
And I would strongly advise the viewers to kind of just make sure that they know their intent prior to the sale, and if that intent changes afterwards, then there might be an opportunity.
Right. And has there been cases where, let's say, somebody does have the intent of moving in for themselves, but the CRA comes and says, you know what, we're not going to accept that claim. Does that happen, or is that not as common?
It does happen initially, but I think if you provide the proper write-up, and sometimes you might have to provide proof of if there's a medical issue. Right. They may ask for a doctor's note, marriage certificate, separation certificate, various things that could come into play. Yeah. And I think that the key to this is as long as you have your detailed backup, then you'll be in a good situation with CRA.
So the more evidence you can provide, the better, obviously. Okay, makes sense. Okay, so next topic, which is very, very common, I get a lot, is corporation. Incorporate or not to incorporate, right? So I'm sure you get that a lot as well. As a real estate purchaser or investor, what are some of the advantages of either or? Is it even beneficial to incorporate or not? And what can you kind of talk about in that sense for both personal or incorporation?
Excellent question. Again, it depends on the personal situation. Right. The main thing to keep in mind is there's that preconception out there that by incorporating, you're actually benefiting from a tax point of view. That's not necessarily the case. Yeah, there might be some additional deductions that you can claim. But the main reason you may want to incorporate is, you spent your entire career building up good wealth, principal residence, maybe you got a couple of rental properties, all these investments. Right. And then if you end up buying a rental property and that particular tenant ends up slipping and falling and they file a claim against you, they could go under your personal effects. Okay. So let's say the property is worth, say, $500,000 and they file a $2 million claim. So that house goes or the condo goes for $500,000, but they can go to your personal effects for the balance. Right. So I often recommend from a creditor proofing or a liability protection point of view, it's better if you incorporate, especially if you have multiple properties. Yeah. And even with that, you may want to form maybe a corporation for a couple of properties and then another corporation for another couple. So you're further creditor proofing all of the properties.
Right. And does it matter as to the number? At what point would you say, okay, this is where I would like to incorporate? It's 3 properties, 4 properties, 5 properties, or is it case by case?
It's case by case. It all depends on what you have saved in your personal situation, right. And the level of risk you're willing to take. Got it. Yeah, I know a lot of people will say we have insurance, which is fine. Insurance will protect you, but sometimes insurance may not cover everything. I see.
So we've covered that main question. Of course, if you have any other additional questions, you can always reach out to Ali Raza. Last question I got here on my document here is about tax HST rebates. So how does one qualify and what is it exactly? Just describe what that is exactly.
Excellent. So HST rebate, essentially what it is that if you can envision your lawyer's trust or closing statement on there and on the purchase and sale agreement, it'll indicate whether you're paying for the HST upon closing of a property or if the builder is paying for it, or if the builder is claiming the rebate or you're claiming the rebate individually. So on there, it'll indicate who's on the hook from paying the HST. Okay. So on closing, even though you may have bought a property for $1 million, you're actually paying maybe $1,130,000, including the HST, right? Yeah. So you're able to claim back the rebate. Now there's two circumstances where you're able to claim it. One is if it's a principal residence. And you've paid for the HST and you're intent on living in there. And then the second is if you're buying it as an investment property and you would like to claim the HST back. Now, in both situations, you would need a purchase and sale agreement. Yeah. You would need similar values of properties that have closed in that point in time, and the actual lawyer's closing agreement or the closing ledger. So those are 3 items that you would need for sure. Now, if your intent was for the property to be an investment property, so if you have a lease in place, then you would need that 1-year lease. Right. And that would be the 4th item if you're submitting it as an investor. Okay. When you submit that, you would go to your accountant. They would fill out the rebate. There's both a provincial and a federal component. Right. And the maximum you can claim is $24,000. Yep. I know there's talks of that amount going up. Now, the reason why we talk about the fair market value of similar properties is because they may adjust the provincial component slightly down because of the delays in the condo closing. Right. So they would say that, you bought it for this much, but similar properties are actually up here. Right. So we're going to adjust the provincial component.
Gotcha. So that's why you asked for the sale price, basically, or for the recent sales.
So we generally ask for 3 MLS listings of similar properties sold around the same time.
Okay. Awesome. No, that was amazing. So thanks so much for giving us this information on the real estate tax strategies part of things. And again, if you have any questions, we can always reach out to Ali Raza personally. So we finished this component. Now I'm going to ask you some personal questions, if you don't mind.
Absolutely.
Right? So Ali Raza, I know you're big into sports, right? What was the sport you played growing up?
Well, growing up, so I played a lot of ball hockey.
Okay.
I played a lot of tennis.
Yeah.
And then recently I've gotten more into both the tennis and the squash.
Nice.
The key is staying active, keeping your mind clear.
Yeah, and sharp.
And sharp.
Nice. What about soccer? I thought you were a soccer guy.
I did play soccer a bit, but it was more my kids played a lot of soccer in recent times.
Are they excited about the World Cup, Canada?
Yeah, absolutely. Yeah.
Nice. Okay. Hopefully they go far. Let's see.
We'll see how it goes.
Yeah. Next question. What's the best piece of advice somebody ever gave you?
The best piece of advice is if you have any situation in life, don't make a decision in haste. Look at all the facts and sometimes keep the emotions out of it. So use the facts, sometimes seek advice, but think about it before you make a decision. Nice.
Last question. What's your favorite travel destination?
Favorite travel destination?
Where you haven't been, by the way.
So. Where I have not been. So I would love to visit India.
India, okay.
Yeah, there's a lot of history there, and obviously our ancestors come from there at some point. Yeah. But there's a lot of sightseeing, a lot of, it's beautiful, and I'd love to visit.
Well, I'm going to Pakistan in a couple of days, so
excellent.
Yeah, I'll take some photos. I'll like how it goes. Thanks so much. Really appreciate you coming on.
Thank you. Appreciate that.
Thanks so much. And if you guys have any questions, let us know. Thanks so much for listening, and we'll see you at the next episode.